So we are currently in the heart of earnings season and there's some big moves going on, and today I wanted to talk about some of the moves and also some stocks that I'm looking at. I'm looking at the earnings report, and there's been a few earnings reports this quarter in particular that have gone not so good, but there was one yesterday that I saw, and I saw AMD's and I looked at AMD's and I was like, that stock is way too high for that earnings report that they've just brought out. But yesterday there was one stock in particular that brought out their earnings and I went, how is that valued at that? Like, this is probably one of the most overvalued stocks in the stock market, and I believe that it's only living at a higher or surviving at a higher valuation because of its past success. And granted, it is a higher quality company, but surely eventually that higher quality company has to be valued off the numbers it's doing. And I thought I'd talk about that one today, and a couple of other stocks that have been reporting earnings as well. I give them a little bit of a mention, so I hope you enjoy the video. We'll keep it nice and short though today. So first of all, Apple. For me right now, this has to be in the top 5 most overvalued stocks in the market, or in particular in the S&P 500. I saw AMD's earnings the other day, and I looked at AMD and I looked at the numbers they did, and I looked at the valuation. I was like, surely that's got to be lower than that. But Apple has to be one of the most overvalued stocks in the stock market, and definitely in the S&P 500. Definitely. This company trades at 32 times earnings. 32, that is a premium company. You know, if you say the average P ratio that a company trades at is around about 20, give or take a little bit depending on the market that we're in. Let's say it's 20. This is definitely trading at a premium to the market. And realistically, a 0.5% dividend yield, it's not much of a dividend yield. But you look at the earnings of Apple, and I mean, the GAAP EPS, you know, the beat earnings, but revenue came in line, and it came in line of negative 1.4%. This company's not even growing. The company's not growing. It's the company is shrinking, and yet it comes in at 32 times earnings. And I thought, well, you know, there's got to be some lower valued. You know, there's so many stocks out there that get valued off what they're currently doing, and people forget what the potential future could be for this company. You know, so often we see companies valued off the current numbers. You know, Meta was the example. Meta, even though you went, oh, it's a bit of a tough time with all the changes that are going through, it'll be okay in the longer term. No, the market went, no, we're valuing off what you're doing right now. And the market absolutely slammed Meta. And yet Apple is pretty much trading at 52 highs. It is at 52 highs. It's at all-time highs. Apple is at all-time highs at the moment when it's doing these numbers. Does not make sense. And then I look at Apple right now, and if you look at the EPS as well, so the current year ago EPS was 1.2, average estimate 1.19. Next quarter, the average year ago EPS was 1.29, average estimate's 1.36. Realistically, on an EPS basis, it's not even growing on an EPS basis. And for the current year, it's actually expected to go down this year on EPS. Now, these are going to be, like I said, you know, that's this year. In the next year, it's forecast to show some signs of recovery in the future. So you go, well, fair enough, like this might just be a really bad year this year for Apple. But even though when you look in the future, it's not like it's a exploding company that's going to rapidly recover in the next 12 months. And that's the crazy thing. And then you start looking at Apple, and you know, at the moment, negative 1% sales growth, basically flat on the sales growth. Current year down 2% on sales. Next year expecting a rebound of 6.7%. I don't even think they'll do that, to be honest with you, because you look at the company itself. I mean, services has been the key driver for the company, you know, going forward. But that's obviously slowing down a little bit now. I can't really see, you know, in this environment that we have at the moment, I can't see that many people going, you know what, I'm going to get a new iPhone, I'm going to get a new Mac, I'm going to get a new iPad. I don't really see the demand there for the new products. So what has saved Apple in the next few years has started to slow down a little bit. And the new products that come through, I can't see selling that well. So I look at Apple and I'm thinking, you know, this year has been a terrible year for Apple. And next year, I think they won't. I don't think Apple will actually do these numbers here. I think that's a bit too high for Apple. But even, let's say they do these numbers here. You know, a 6% growth company. I mean, I know Apple's a great company, but 32 times earnings for this? Really? Like, I just think that's absolutely crazy. And, you know, I always say I wouldn't want to short Apple because it is one of those companies that I wouldn't like to bet against. You know, it is a major brand out there, and people will still, you know, go out and buy the products, but it's just absolutely crazy. And then I was looking at something like PayPal the other day. We covered this the other day. We talked about their earnings, and I think the stock was down 7% after the reported earnings. ended up yesterday being down 12% off their earnings. 12%. I could not believe I saw PayPal down 12% after their earnings. And this is the big difference here. So we talked about Apple and the struggling numbers, for example. And you look at something like PayPal. So a year ago, EPS 1.08. This year, 1.22. Great improvement. 1.24 up to 1.4. A year ago, EPS 4.13. This year, up to 4.95. Next year, they're expecting, obviously the year that would have just gone was 4.95. They're coming 5.66. That's great EPS growth. That's what you call really good EPS growth. You look at revenue growth, 7%. You know, this company is a company that's had a few issues at the moment with the macro environment hurting them, but they're still coming out with 7% growth. By the time we get to next year, the forecast is 9% growth. So you've got a company here that's rapidly growing their EPS. I mean, on this year here, you're expecting nearly 15% EPS growth, 9% revenue growth. And then you look at what this company's trading at. Granted, Apple is currently 32 times earnings and PayPal is 27 times earnings. So even from that point of view, PayPal is a lot cheaper. You might argue that Apple's potentially a better brand, potentially, but it's still cheaper. But then you start factoring, well, obviously, what you want to be doing as an analyst and as an investor, you want to be thinking, well, what they're doing next year, what they're doing the year after that. You want to be thinking about the future. You start thinking about the future because Apple aren't going to be growing that much. This company's going to be 29 times earnings next year. You look at something like a PayPal. PayPal is currently a 14 times earnings next year. It's over half the valuation. It's over half the valuation. You're getting much faster EPS growth. You get much faster revenue growth, but you look at, the revenue growth is going to be 50% higher than Apple. And you might go, well, Apple is a bit more of a premium brand, but should there be that much difference in it? And I'm looking at that thinking, either Apple is way overvalued or PayPal is way undervalued, or it could be both of them, but there's something going on. There's something going on between one of them. And I looked at Apple yesterday. Apple that brought those earnings out and was down 2%. After hours, and then I looked at PayPal that was down 12% after their earnings, and I thought, I know which one for me is the better earnings. I know which one should be down 12% and which one should be down maybe only 2%. In fact, I think one of them, this one here, I think this one should have been up after those earnings. I think 14 times forward earnings for a company that just grew whatever it was, 7%, and growing that EPS at the rate it is. I was like, that should be up. That should be up. But hey, that's the stock market for you. Millie, I just wanted to mention this one really quickly. We talked about the really bad day on Wednesday, dragging the market down, and Mercado Libre. Obviously, they brought out earnings which were ridiculous. Like, you're talking 10 out of 10 earnings for Mercado Libre, and the stock was only up like 4 or 5%. And I said, this is probably, the red day just weighing this stock down after those earnings, because they are brilliant. They're 10 out of 10 earnings. When you're beating the EPS by over 15% on the estimates, you should be up a lot. And eventually, as you can see here, the market kind of went, oh yeah, that should have been a bit higher than that. And that was good to see that, even though I feel like the market got these two stocks wrong or mixed up, it was good to see the market actually for Mercado Libre went, oh, that should be a bit higher than that. But, I mean, obviously, I know a few people were frustrated because a few people were like, I wanted to buy a few shares in Mercado Libre. So for you guys, maybe a little bit annoying, but at least it was a bit more reflective on how good that earnings report actually was. Amazon, just want to shout this one out real quickly. Really, really good pop-up for Amazon after hours. Stock is up 8%, and looks like one of the strongest earnings reports for Amazon for a while. So well done to any of you guys that were buying some shares in Amazon. If you look here, the EPS was 0.65 compared to the 0.34, but it seemed like there was also a big swing on the investment they have in Rivian. This was one of the big factors that was pressing down Amazon not so long ago, and I think a few people ignored that pressure that it had on Amazon. And obviously, while we had a horrible stock market in 2022, that's not happening in 2023. So obviously, that was being a big swing for Amazon, and obviously helped them a little bit on that point of view. And sometimes is why it's always a little bit tricky to predict the profitability on Amazon. Revenue 10%, obviously really good. 10% growth, back to double-digit growth for Amazon. Obviously, that's really strong. Only little thing I thought is Amazon Web Services. That increased 12% year over year. I wonder if the market would have a little bit of a wobble off that. I don't know if they were expecting a little bit stronger than that. But obviously, it kind of went, no, it's okay. So, yeah, obviously, that's worth pointing out. The guidance well in the third quarter was pretty decent, as you can see here as well. So, yeah, all those guys that have been buying up Amazon, I think you'll be pretty happy after that earnings report. And obviously, the shares are doing really well. Obviously, the last stock I'm going to mention on this video, if I didn't mention it, obviously, there's got to be something wrong with me. DraftKings. Now, I'm going to do a full dedicated video to DraftKings, going through their earnings. It'll probably be tomorrow now. Just so I can, after I've got back from work, I can sit down, go through the conference call and slap it all on that whiteboard behind me and go through all the earnings and see what's kind of going on here. But I've got to mention it. Obviously, wow. Up 12.3% after hours. 12%. And honestly, we're heading towards new all-time highs. The all-time highs was, or 52-week highs. 52 highs was $32. Obviously, we're looking to enter towards $33 today, and it deserves it. It deserves it. And honestly, like, it's once again one of those moments I just got to step back and go, we went through a lot of crap in 2022. Me having to every kind of single day in 2022. You're talking probably over 200, 300 videos. Every single, all through that year, maybe even a little bit longer. 300, 400 videos, like, trying to justify why DraftKings at $10 is absolutely bonkers, and having to keep buying and make sure that everything, I'm looking at this going, what am I missing here? Because to me this looks like an absolutely amazing opportunity, but the market's putting it down at $10, and the amount of crap as well in the comment section you have to take, like, oh, DraftKings is down at $10, it's terrible stock and all this, and it's like, there we go. It's good to see it getting towards the right valuation right now. And for any of you guys that bought in the dip as well, it's absolutely fantastic. And really quickly, I won't spend too long on it because I want to do a full video tomorrow about the actual earnings. But honestly, 10 out of 10 earnings report, 10 out of 10. This is, I didn't think they would have been able to do this earnings report without the NFL, and they did. I am going to say straight up, this is the best report I've seen in an earnings season. In every single company. I've not seen an earnings report better than this. This is magnificent. The non-GAAP EPS 0.14 beat by 0.28. Now this is what people questioned, a lot of people questioned the EPS, the profitability, and look at the ramp up on it now. It is crazy. And a lot of people said, oh, well, as soon as they start focusing on profitability, revenue growth will go. Revenue, $875 million. 87% year over year growth. Beat by $112 million. It's scary. It's scary how good it is. I on those numbers, I could say that this is the best ever quarter I've seen DraftKings do. And I've seen them do a lot of good ones. It's unbelievable. I mean, monthly active players up 44%. I remember, some of you guys might remember this. I remember in, I think it was 2022. It might have been the second quarter or the third quarter. I remember people questioning DraftKings saying, oh, the monthly active users are falling the week, the losing users. And I think the stock went down 20%. And it was like, it was absolutely bonkers. Obviously up 44% this time. Average revenue up. Obviously, raising its guidance of revenue, raising its guidance of EBITDA. In fourth quarter to get EBITDA of 175 million. It's supposed to be this was only a few months ago. This was the quarter they were supposed to get break even, and now they're doing 175 million in EBITDA. It's scary. It's absolutely scary. It's scary, these numbers. They are magnificent. They are absolutely magnificent, and it is the best quarter I've seen in Q2 earnings. This is the best company I've seen report earnings. It's absolutely fantastic. It's absolutely fantastic, and I'm so happy. I'm so happy that this is smashing it this much, and the amount of time that I've committed to this stock, and the amount of videos that I made on this stock, and putting the brand of the channel behind this stock. and it's fantastic. It's absolutely fantastic, guys. So I'll leave you on that. I'll leave you on that note. Hope you enjoyed it. Congrats to any of you DraftKings shareholders. Catch you in a bit.